Welcome back to Ag Enterprise Management. I'm your lecturer for the course, Matthew Johnson. If you haven't done so already, go check out the course website. Check out the syllabus. This week we're going to be talking about basic management through financial statements. Learning outcomes. So yeah, basically we're going to be going over the basic financial statements. This includes the balance sheet, income statement, and statement of cash flows. Learning objectives. Learn how to analyze basic financial statements for making managerial business decisions. So, standard financial statements. There's a whole lot of different financial statements that we could go over, but really the three major basic ones that are ubiquitous with all businesses, and anytime you're talking to someone about the financials of an organization, these are always typically going to be the first three documents or reports that they're going to be looking for. So you have your balance sheet, and you also have your income statement, which is also known as your profit and loss statement, and your cash flow budget. All right, so who uses financial statements? All right, so obviously you as the owner or manager, all right, you're going to be using these financial statements to make financial decisions. You may be looking at different reports weekly, monthly, or maybe even on a daily basis. Employees, you may share financial statements to have a more transparent business operation. This could be really good, especially if you have employees that are saying, hey, really could use a raise, but maybe financially the business isn't doing that well. So you're able to be open and upfront with your employees, showing them, hey, here's the situation. If we're able to, increase revenues in other areas, then at that point, maybe we'll be able to revisit the idea of wage raises. All right, investors. Yeah, so someone's looking to invest or be a partner in the business. That's going to be one of the first things they want to see, is understanding the financial health, the financial situation of the business. All right, so they're going to be just basically trying to determine what is the value of the business. Is the business making money? How much money is it making? Those are all important questions to be able to answer. Financial institutions. This basically includes banks, credit unions. So if you're going to a bank asking for a loan, or a granting organization, they're going to be asking for different financial statements to determine whether or not the level of risk for the business to provide with a loan and or a grant. And of course, the government. Yep, guys like the IRS, Hawaii Department of Taxation, they are used to ascertain the propriety and accuracy of taxes and other duties declared and paid by a company. Huh, that sounds like a very government thing to say. Oh, propriety and accuracy used to ascertain. Huh. I'm gonna start using those words more often in my daily talking. And we also have vendors. So if we remember, they are anyone that we're buying products from to support our business. So if you want to be able to get credit from that business, they may be asking for some kind of financial reports to determine, to ascertain the propriety and accuracy of your financial situation, and whether or not they can extend credit. Oh, see, there we go. I already just used ascertain and propriety. Awesome. Fantastic. All right, one of the first documents, financial statements, that we look at is the balance sheet. The easiest way to remember about a balance sheet is that it is a snapshot in time. So anytime someone is asking you for a balance sheet, they need to either give you, or you have to ask typically for what date. What date of the balance sheet. And typically it's at the end of the year, or end of the fiscal calendar for the business. So a lot of times you'll see balance sheet for business X as of 12/31/2018. Right? So this is the balance sheet for that business at that specific time, and the balance sheet could literally change day to day. Probably is. And there's three main components of the balance sheet. Once again, remember that this is showing us really the financial snapshot of a business at a specific period of time. So, and the structure of the balance sheet is always set up as it is, as we're looking here on this slide. So on the left side, you have your assets. Right? Assets are things that you own. And then on the right side, you're going to have your liabilities plus your owner's equity. Okay, so liabilities are going to be things that you owe, and owner's equity is basically the money that's going to be left over in the business after you use all of your assets to pay off any liabilities that you may have. Oh, yeah. So there's some wording on the balance sheet. See, I nailed it. I don't need any notes to pop up on the screen. But yeah, once again, balance sheet shows a snapshot of a company's assets, liabilities, and shareholders' equity at the end of the reporting period. So it does not show the flows into and out of the accounts during the period. Okay, so there's other reports that show that. All right, so as we mentioned, assets, these are the things that a company owns that have value. This typically means that they can either be sold or used by the company to make products or provide services that can be sold. All right, so items that are included under assets are obviously cash. All right, it may be physical property, such as a tractor or maybe a piece of property. Could also be trucks and any equipment and inventory that you use in the business. Okay, if remember, the opposite of liabilities or opposite of assets actually are liabilities, and these are things that a company owns to others. This can include all kinds of obligations like money borrowed to launch a new product, rent, money owed to suppliers for materials, payroll, environmental cleanup costs, taxes, anything that if you were going to try and sell the business, you have to pay off any of these liabilities, any of these bills, outstanding bills that you have. All right, so the third part of the balance sheet is a shareholder's equity. Mentioned before, this is can be thought of as the net worth of the business. So it's money that would be left if a company were to sold all of its assets and then paid off all its liabilities. This is the money that's left over for the shareholders or the owners of the company. All right, so here we go. This is typically what a balance sheet is going to look like. So we can see on our left are the assets, and then on the right we have the liabilities and the shareholders' equity, which is listed there at the bottom. You can see that it balances out. So total assets equals $19,000. And then the total liabilities plus the shareholders' equity equals $19,000 as well. All right, this kind of generally makes sense, yeah? So if we think about the example, if we're going to sell the business, all right, so be able to sell the business, all right, before you can just run away off to a remote island or whatever it is you do when you sell a business, you got to pay all your bills, all right? You don't want people chasing after you. It's just, it's what you got to do. So to be able to do that, you got to use the assets, which are on the left side. Okay, so let's look at the assets that are listed here. All right, so we have cash on hand, all right, about $1,500. Then we've got cash in the bank, $2,200. Then we've got accounts receivable. So this is a good term to know. Accounts receivable is money that people owe you. All right, it's just a fancy way of saying, hey, people owe me money. All right, so this is the total amount of money that's due to you. So maybe you sold some products to some restaurants. All right, restaurants are notorious for taking their time to pay. So that time between when you deliver a product to the restaurant and the time that they pay, the value of that amount of product is going to be held in the accounts receivable account. And then maybe we have some product in the fridge. All right, so the value of that is $3,500. All right, So all of these assets that we just went through are considered the current assets. All right. So it's about $15,660. Then we have what we consider more long-term or a fixed asset. All right. So these are items that will probably take a little bit longer to turn into cash. So here we have aquaponic equipment that's valued at $3,400. All right. So, to be able to get that $3,400, we're going to have to be able to sell the equipment. So that may take a little bit of time. So that's why we consider it as a fixed asset or a long-term asset. All right. Then over on the right side, we've got our liabilities. Okay. So these are things that we owe. All right. So opposite of accounts receivable is accounts payable. So this is a value of items that we owe to other people or businesses. Okay, so we put that under the current liabilities of $5,400. Then we have what's considered more of a long-term liability. So these are typically loans. So here we have a loan from Mom. Thanks, Mom. So she gave us, or we still owe her $10,500. Just got to make sure Mom gets paid. So when we add our current to our long-term liabilities, we have total liabilities of $15,900. So what we can see here is that, so we've got $15,900. So if we were to go ahead and pay off all those bills, pay the accounts receivable, pay back Mom, using our total assets of $19,060, that leaves us with a remaining amount of $3,160, which is the shareholders' equity, aka net worth. All right. So that's why when we go ahead and we add up all of our liabilities with the shareholders' equity, it's always got to equal our total assets. So that's why we call it the balance sheet. Okay, now on to the next financial statement. Yes. Income statement, also known as the profit and loss statement. It's so popular, it's got two names. And this is really a way to understand where how money is flowing in and out of a business over a stated period of time. All right. So income statement is a report that shows how much revenue a company earned over a specific time period, usually for a year or some portion of the year. Income statement also shows the costs and expenses associated with earning that revenue. The literal bottom line of the statement usually shows the company's net earnings or losses for that period of time. This tells you how much the company earned or lost over the period. Okay, so really we're tracking, okay, how much money came in? What, how do we categorize that money that came in? And then we're going to break that down, showing how the money went out as well. And then at the bottom, as we're seeing here in our little staircase, we have either our net profit or our loss. So let's take a look at an example. All right, so here we have an example of MicroMachine Green's income statement from January 1st to February 28th, 2019. So once again, remember we're talking about how a balance sheet is a specific period of time, so it'd be a single date, where the income statement is going to be over a period of time. So here we have a period of 2 months. So at the top, we show all the revenues that came in from that period of time, so just over $100,000. And then we start subtracting the expenses. Okay, so the first thing we do is we take out the cost of goods sold. So these are going to be whatever items that you sold to bring in your revenue. It's taken out whatever it costs to specifically produce those items. So if you're selling all eggplant at $4 a pound and it costs you $2 a pound to produce it, then your cost of goods sold is the $2. So items that might go into that would be the cost of seeds, might be the labor for people actually out in the field growing and maintaining and doing different things, maybe any kind of specific inputs that you're putting in to come up with that cost of goods sold. So this gives us our gross profit. So it's not ugly profit, it's just a weird, strange word that they use in business for kind of like your first level of profit. Okay, so we start off with $100,000 in revenues. We take out $45,000 in cost of goods sold. That leaves us with a gross profit of just over $55,000. But we still have more expenses that we need to account for. So we can't just run away with that $55,000. So over that period of time, we had other staff that we had to pay. So maybe a manager, maybe an accountant, maybe an administrator. So this was a payroll expense of just over $14,000. And then you start taking out all of your other expenses. So for this example, we had gasoline and supplies. But we also could have a whole variety of other expenses, anything from utilities, insurance, marketing, a whole endless amount of expenses. So this is what we call our operating expenses. So the operating expenses were just over $31,000. So now we take that $31,000, subtract it from our gross profit, and now we're left with an operating income of $23,800. Okay, but we're still not done yet. We still have additional expenses to account for. Okay, so if we have a loan, we may have to be paying interest. So any interest expense that we're paying for, over that period of time, we got to subtract that from the operating expense. Okay, so this gives us our income before income taxes. Okay, so great. Now we have $23,335,000. Now we need to pay taxes on that. So we have an income tax expense here of $5,200. So this gives us a total net income of $18,135. All right, so this is the money that's left over after everything's been paid. Okay, so likely this is a good couple of months, $18,000 in profit. But maybe if it hadn't been such a good month, we may have actually had a loss for that period of time. So that's what we use this report to be able to track what's actually happening. All right, cash flow budget. All right, so cash flow budget projects a company's inflows and outflows of cash. All right, makes sense. This is important because the company needs to have enough cash on hand to pay its expenses and purchase assets. Okay, so cash flow is really tracking specifically when money is coming in and when it is going out. So for a period of a year, if we look at just the income statement, we could show that we had a net profit of $18,000. But if all of our money went out in the first 3 months and we didn't have money coming in until the later part of the year, we might be in serious trouble. So even though it shows over the year that we made a profit of $18,000, we still have to keep track of the timing of money, especially with farming. There could be issues where you have a lot of expense in the beginning for starting up a farm. You have to prep the land, you have to buy all of your ingredients, or all of your inputs actually, seeds, you have to pay labor before you start actually having to harvest. And this could be anywhere from 30 to 60 to 90 days of longer. So we really have to pay attention to that. And that's what the cash flow budget is with. All right, so cash flow budget is a useful management tool because it forces you to think about your production and marketing plans for the year. Also, test your farming plans. We produce enough income to meet all of your cash needs. Okay, so do you have enough cash on hand to get you through those slow times where you are busy growing your products before you're able to maybe take them to the farmer's market? Projects your need for operating credit and your ability to repay borrowed funds. Okay, so if you do see that, like, hey, you know what, I'm actually going to have a slow couple of months, I'm going to be short on cash, well then maybe you need to take out a loan. So hopefully you know this ahead of time by doing some projections, some planning, and being able to anticipate when you're going to be short on money. Or I said projects when you must borrow money and when you can repay it. It helps you control your finances. By comparing your budget to actual cash flow, you can spot developing problems because of an unexpected drop in income or unplanned expenses, and spot opportunities to save or invest funds if net cash flow is higher than expected. That'd be nice. Okay, so here is a example of a cash flow statement. So as we kind of see, we're showing the money that's going in and the money is going out month by month. Okay, so then we're able to kind of project where the money is actually happening. Okay, so in the upper left-hand corner there, we have the beginning balance of $15,000. And then kind of going month by month, we can see the cash receipts of money that we're receiving. So we have customer payments. And then we have the cash being paid out. All right, so this is purchasing packaging, supplies, advertising, vehicles, insurance, paying salaries, all these other kind of things. So then it shows at the end of January, we have a little bit of loss for the month. So we're down to $14,742. Okay, then we kind of go see through month by month what's happening. So this is actually something that you typically will do ahead of time. So this is a planning document. So a lot of times companies will do this at the beginning of the year to kind of anticipate their budget for the upcoming year. Okay, so that's it for financial statements. Make sure to check out the course website for any reading and additional assignments. Aloha.